Hello and welcome to the Naked Expat channel. I've had quite a few emails regarding estate tax and inheritance tax, not only from British citizens, but also from subscribers in the US and in Australia. And estate tax and inheritance tax is a very, very complex subject, but it affects all of us, and there are considerations that you need to think about before becoming an expat. Let's take the Philippines, for example, because there's been a lot of confusion and misinformation online, surprise, surprise, and even incorrect answers from the wonders of ChatGPT, which sometimes spits out complete nonsense. So if you're interested in estate tax and inheritance tax, listen up. Under Philippine law, even though an SRV holder or a 13A spouse's visa holder is deemed a resident alien, estate tax liability only applies to assets situated in the Philippines. In other words, the Bureau of Internal Revenue can only assess tax on property that is physically or legally located in the Philippines. For example, real estate, Philippine bank deposits, your SRV deposit, shares in local companies, or tangible assets held here, like condos, for example. Offshore assets, such as investments or cash held outside of the Philippines, fall entirely outside the scope of Philippine estate tax. The 6% rate that is often mentioned online and by ChatGPT only applies to Philippine situated property. The 6% on everything, like the 6% on your worldwide assets idea that you may have heard online, is unfortunately a common misconception. As for UK inheritance tax, that depends on domicile, not residence. A British national remains UK domiciled for at least 3 years after leaving the UK and can be deemed domiciled for up to 15 of the last 20 years of UK residence. Do stick to the end of this video because I'm going to go into deemed domicile in a lot more detail, which you may well find extremely interesting. Once you are genuinely non-UK domiciled, only UK situated assets fall under UK IHT, inheritance tax. There is no estate tax treaty between the UK and the Philippines, but in practice this doesn't create double taxation because each country taxes on a different basis. The Philippines by situs, in situ, and the UK by domicile. They are two completely different tax systems. For example, in my own situation, I've set up a discretionary will trust so that any assets on my demise that are offshore fall into the will trust for the benefit of my son as a solo parent. That structure only comes into effect upon my demise and typically governs offshore assets. Since the trust is created under English law and holds international, non-Philippine assets, those assets are not taxable in the Philippines. The trust's beneficiaries, my son, would not have exposure to Philippine estate tax, that's 6%, unless the trust holds Philippine property directly, which it doesn't. So in short, Philippine estate tax only applies to Philippine assets. Offshore discretionary will trusts remain outside Philippine tax jurisdiction. UK IHT, UK inheritance tax, applies only if you remain UK domiciled, which I'm going to come on to, guys, because you need to understand the intricacies of it. There is no overlap or double taxation between the two systems. Now, for SRV holders and 13A visa holders, the practical steps are simple. Keep Philippine and offshore assets legally separated. Maintain a Philippine will for assets held here in the Philippines and a separate international will for everything else. Then it's clear and concise. And if you can, ensure bank accounts and real property in the Philippines are held and titled correctly, and if possible, joint ownership with survivorship, because that can simplify things if you're married. So if you have a joint bank account and you die, then simply you drop off the bank account and the remaining spouse stays on the account, and that's simple, straightforward. It just gets passed on to him or her. Now, regarding the points I've outlined, these don't only apply to UK citizens, but they apply to any foreign national holding an SRRV 13A or other non-citizen visa in the Philippines. The determining factor for Philippine estate tax isn't nationality, but where the assets are situated. So, regardless of whether someone is from the UK, the US, Europe, Australia, or elsewhere, the Philippines only taxes assets located in the Philippines. Offshore assets like bank accounts, investments, trusts, or overseas property are not within the Philippine tax net. The difference is how the person's home country taxes their estate. And this is where it gets interesting. The UK system is based on domicile, so it taxes worldwide assets if you're still UK domiciled. The Philippines system is based on situs or in situ, so it taxes only Philippines situated property. The US, by contrast, taxes worldwide assets of its citizens, wherever you live. But it does have a tax treaty with the Philippines. Under that treaty, estate taxes paid in one country can be credited against the other, avoiding double taxation. So yes, theoretically, a US citizen could be liable for both US estate tax on worldwide assets and Philippine estate tax on assets held situated in the Philippines. But they would receive a tax credit under the treaty, so they don't pay twice. You are likely as a US citizen to be taxed on your worldwide assets, including the assets held in the Philippines, on your worldwide assets in the States. And therefore you receive credit for that tax paid, and you can show the Bureau of Internal Revenue in the Philippines that you've already paid tax. So there'll be no liability to local taxation in the Philippines on those assets because you've already paid tax on them in the States. Now, I'll come on to UK deemed domicile issues in a moment, but just to finalise this point, there is no situation in which the Philippines would tax a foreigner's worldwide estate. So if you get told otherwise by ChatGPT or some online guru, they're talking a load of BS. It's incorrect. Even if your home country taxes you, the Philippines limits its estate tax to Philippine property only. Now let's move on to UK deemed domicile issues. Over to my whiteboard. Welcome to my famous whiteboard. As I mentioned earlier in the video, for UK citizens, it's very important that you get your UK domicile and deemed domicile situation correct. Because not during your lifetime really, but upon your demise, it's hugely important for your beneficiaries when you die as to how much inheritance tax potentially your estate is liable for. Now, under the current situation, a UK citizen is taxed after they've got a nil rate band of currently 325,000. This is all in sterling. When your estate is worth more than 325,000, you're liable to inheritance tax at, as you're probably aware, 40% IHT. It's a lot of money. Now, your nil rate band is 325,000. If you own property, there's also residential relief. So you've got what's known as a residential nil rate band. And it doesn't have to be your main residence. A lot of people think it needs to be your main residence, but it doesn't. And that's potentially an additional 175,000 allowance, which makes 500,000. Now that residential nil rate band isn't disposable. It's if you leave a property to your next of kin. They have to be like direct descendants, so your children or grandchildren. They can't be like distant nieces and nephews and second cousins and things like that. But if you leave a property upon your demise to your next of kin, then this residential nil rate band allowance can also be used. If you are a married couple, British citizens, so this doesn't apply if you've got a Filipino wife or a Thai wife or other, this of course is ×2. So effectively, you can have an estate worth £1 million before you start paying 40% inheritance tax. And if between Mr. and Mrs. or civil partners, if one of the spouses or civil partner dies without using all of their 325 or 175, then the remaining spouse or civil partner can draw back into their estate the unused relief from their partner. So that's the situation. You either got one lot of 325 and 175 if you've got a property in the UK. If you don't own a residential property in the UK, then forget that. Assets of over 325,000 are going to be taxed. It doesn't take much nowadays to exceed that 325,000. You might have various savings, personal equity plans in the past, PEPs, ISAs, savings, investment portfolios, cryptocurrency, whatever it might be. To exceed that, if you factor in maybe a property that you've got in the UK rented out as well, even if you're an expat, then you can quite easily exceed that 325 allowance. And it's not uncommon. You don't need to be super duper wealthy to have estates worth 6, 7, 8, 900,000. And bearing in mind that some pensions on your demise will also pay funds to your estate, depending on how long it's been since you started claiming your pension or you didn't claim your pension, there might be some net worth to that, as well as life assurance policies and things like that. So you could end up with a huge amount of inheritance tax, 40% on anything above 325. Well, why is this important to expats? I mentioned at the very beginning of the video about UK domiciled or deemed domicile. And this is really important, guys, because if you become an expat, you have to be outside the UK for 3 years, at least 3 years plus, to be deemed not a UK domicile anymore, at least 3 years. However, there's a catch-all in HMRC legislation, which means you can be not only domiciled outside of the UK, but you can be deemed domicile in the UK for up to 15 of the last 20 years. So HMRC can go back and say, right, okay, what have your movements been over the last 20 years? Question mark. And they can go back over the last 20 years, 15 years, to see where have you been, what you've been doing. How many days have you spent in the UK? Have you spent more than, say, 183 days? Have you been predominantly in the UK in 1 year? Have you been more than 90 days in the UK in any one particular year? And they'll look into this in great detail if you're a high net worth client. So if you're lucky to have a estate worth in the millions, 2, 3, 4 million and more, HMRC are going to be looking at this in considerable detail. If you just leave the UK, you think, okay, I've left the UK, I've been living in Spain or Thailand or Philippines for the last 5 years, I'm fine. Well, are you? Because here's where there's some problems. I'm just going to wipe my board. When I was still in the investment arena, there was a very famous case that went to the appeals court. Initially, the member of the public, the client, won their case. But when HMRC took it to the appeals court, HMRC won. And what it was a millionaire that had moved out of the UK, British millionaire, they'd moved out of the UK and had been abroad for at least like 5 years. And he basically said, I'm not liable to inheritance tax upon my demise. And I'm not liable to any capital gains tax or income tax at all, because I've made a clean break from the UK. And HMRC said, we don't agree with that. We don't think you have made a clean break from the UK. This particular person lost his appeal case with HMRC because he maintained a UK cellular mobile phone contract. He could have simply had like a burner phone, a disposable phone, pay as you go. But he had a contract. And because he had a mobile phone contract, HMRC successfully argued that he had not made a clean break from the UK. Therefore, in the last 15 to 20 years, he could be deemed still UK domiciled. He'd moved all but one of his bank accounts and all of his assets and everything away from the UK and had not physically set foot in the UK for more than about 2 weeks a year, visiting friends and remaining family. But because he maintained a mobile phone contract, HMRC successfully appealed the initial decision, no, you're UK deemed domicile because you have not made a clean break from the UK. Why is that important now? Well, some of you might be 2 steps ahead of me already. Because a lot of expats will, for certain reasons, maintain a UK bank account, for example. Now, I'm not going down the route that I normally go down, which is, look, with regards to state pension, and you're basically lying to the state by saying that you're living in the UK and you benefit from the state pension uplifts. I'm not talking about that today. What I'm talking about today is whether or not you are actually an expat and what can trip you up in the eyes of the HMRC, the Inland Revenue. Because you might think, I've been in Spain or I've been in Thailand or I've been in the Philippines for the last 10 years. I'm not liable to UK capital gains tax, income tax, or on my demise, my beneficiaries were not liable to IHT, because recent changes in legislation means that inheritance tax is only payable now on assets held in the UK if you're an expat. So this is where it's really important for most people, because a lot of people have got assets more than that 325,000. Remember me mentioning. You might not have residential property, but you might have lots of investments that are worth more than £325,000 when you add them all up. Now, if you've got less than or equal to 325,000 in assets in the UK, fantastic. You've got 0 inheritance tax. For you foreigners that are not British, estate tax. You've got nil, nothing to pay, because you've got less than 325,000, which is the nil rate band allowance in assets in the UK. You could have 7 million offshore. Could be more than that. Could be $1 offshore. But whatever you've got offshore is ring fenced if you're an expat, and the UK government are only going to basically make you liable for inheritance tax on assets that are in the UK of 325,000 or more. Outside of the UK, offshore, you can hold whatever you want. It doesn't matter how much you've got offshore. At the end of the day, you're not going to be liable to inheritance tax on it, because you're only going to be liable to inheritance tax on assets in the UK. Similarly, if you're in places like the Philippines, over here, the Philippines only taxes you on assets that you hold in the Philippines. It doesn't tax foreigners on assets that you hold offshore, either in an offshore investment account or in the UK, which again is away. It's only interested for estate tax, which in the Philippines is 6%, estate tax on assets you hold in the Philippines. So that's why I say rent, don't buy, because at the end of the day, if your assets are offshore and you've got limited assets in the Philippines, you won't be liable to estate tax in the Philippines. The vast majority of your wealth is offshore, so you're not going to be liable to UK inheritance taxes. You might have, say, a small place in the UK which you rent out if you're so inclined to do so to provide you with a passive income, but nothing else. So you're great, you're absolutely fantastic. But this is only of benefit to you if you are deemed non-UK ordinarily resident. And you're not deemed UK resident, and you can be deemed UK resident if you mess up. Now you can mess up by, let's take a real example here. I'm just going to wipe my board. Now a real life example could be that, as I've said previously, it's not necessarily a bad idea, is you downsize if you've got a larger house because you want to shift your assets offshore so you're below that 325,000. And I know there's, I've been very grateful for a couple of emails I've had from people that said, yeah, but there's renters' rights and potentially capital gains tax if you sell the house because you're an expat and it's not your main residence anymore. Well, yeah, but you don't have to worry about that so much because your intention should be to keep that property until the day you die. And when you die, capital gains tax liability dies with you. So what? It doesn't matter. You're using this rental house as a cash cow. So, and you don't, where you might have a problem, which I'll come on to, is if you reserve access to that property or part of that property, a percentage of it proportionally. But if you've got a small property in the UK worth less than 325,000, then it's going to be under the nil rate band threshold, so it's not a problem. Now, there's your little house, and you rent it out. So it's rented. And you're living in Thailand or the Philippines. Well, hey, great. You're going to get rental income from that. And let's say you rent it out for, let's just be conservative. Let's say you rent it out for £1,000 a month. How are the tenants going to pay you? Well, they're going to pay you for ease and convenience, probably by direct debit or whatever. They're going to pay you into a UK bank account. Now, bearing in mind, I'm talking to you guys with my hat on from HMRC. Have you made a clean break from the UK? Well, if you've got no assets in the UK and you've sold up and you've buggered off to Asia like I did, then that's absolutely a clean break. But if you've still got assets in the UK, you have to be very, very careful because HMRC could argue, well, you haven't made a clean break from the UK, therefore we'll still deem you as UK domiciled. So that's why you have to make sure that you've dotted all your I's and crossed all your T's. You can still hold property in the UK, less than or equal to the nil rate band. Probably make sure you own a small little house comfortably below the nil rate band. The property prices are likely to increase, as I've said before, increase more rapidly than the nil rate band will. So if you buy a house for 250,000 and rent it out, then chances are in 10 years' time, it's going to be higher than whatever that nil rate band is gone up by, if it goes up at all. So you can say, well, the only reason I've got a UK bank account, Mr. Taxman, is to receive my rental income. There's my bank statements. I'm living in Spain. I'm living in Thailand. I'm living in the Philippines. There's the money going into my UK bank account. And once it accumulates a reasonable amount, let's just say £5,000. So once it gets to 5k, I pay it out. And it goes offshore. There's your offshore. It goes offshore, or it goes to Wise, or it goes to Revolut. Doesn't matter. It gets paid out. It goes to Wise or Revolut, or goes to your offshore account. Whatever it goes, it doesn't matter. The only reason that you've got that UK bank account is to facilitate the rental income. HMRC know about that. If you're liable to any income tax on that, you pay it. You're liable to tax on it, depending on your tax status, depending on where you're deemed ordinarily resident. That's fine, because it's justifiable why you've got that UK account. The problem occurs when you keep UK bank accounts and various investments, and your behaviour is such that HMRC could successfully argue that no, you're not an expat, because you've got too strong a foothold still back in the UK. You've not made a clean break. Doesn't mean you can't own property and rent it out and live abroad. Doesn't mean that. But let's say, for example, you maintain a UK bank account just simply to, say, for example, fudge the system and get your state pension uplifts. because you're living in Thailand, but you maintain a UK bank account. Well, not only are you defrauding DWP and are liable to potentially criminal proceedings, but also you're messing up because you'll be deemed domicile UK. And if you're in Thailand and you're worth more than the nil rate band, let's say you're worth 500,000, 600,000 with your property and your assets, your savings, your investments, and maybe a independent pension fund, life assurance, anything else. Well, you've shot yourself in the foot because you're not an expat. And if you're not an expat, you're not taxed just on your assets in the UK. Under UK domicile taxation, you're deemed UK resident and you're taxed on your worldwide assets. So whatever you own, absolutely everything, above 325,000, you're going to pay 40% inheritance tax. You shot yourself in the foot. Well, you might not care because you're dead. But what about your children or grandchildren? What about your beneficiaries? What about your legacy? Whereas if you'd not tried to play the system and you actually made a clean break from the UK and only maintained a minimal footprint in the UK, like say a bank account to receive rental income on an investment, that's justifiable. But you don't maintain a UK phone contract, you just have a pay-as-you-go phone, if you're able to do so, and you have minimum exposure to the UK, you can basically prove that you've made a clean break from the UK and you are non-ordinarily resident in the UK. You're an expat. And then the wonderful new legislation takes effect where assets in the UK only are taxed for UK inheritance tax and only if it's above that figure. And one thing I wanted to also mention and clarify, if you rent a property out in the UK and then you go and live abroad as an expat, one person did drop me an email previously and alarm bells started ringing in my head because they mentioned, well, I've got a property and I rent it out, but I retain a small apartment in the property as a base for myself whenever I want to go back to the UK. Be very, very careful because if you rent a property out and again, you need to make a clean break from the UK, HMRC could quite rightly argue, well, you've not made a clean break from the UK because you're retaining an element of that property for your own personal use. As I've mentioned previously, that could be a big issue in the future. If you think that you are non-ordinarily resident in the UK, but HMRC, because you've tripped yourself up, can rightfully prove that you've maintained a foothold in the UK, and therefore they will deem you ordinarily resident in the UK and therefore liable to inheritance tax on your worldwide assets. So be very, very careful, and if in doubt, the general rule of thumb is remember a clean break from the UK. So absolutely maintain the minimum amount that you possibly can when it comes to ties to the UK. I hope you found this interesting. Please like and subscribe if you've not already done so. And please mention my channel to other people you might know that may be considering becoming an expat. As I always say, we are all very unique, but we do have similar traits. Taxation, inheritance tax and estate tax is an extremely complex situation. I would advise that if you've got any queries whatsoever, you seek professional advice. Naked Expat, stripped back to basics. My goal that I wish to achieve is to make people aware of potential pitfalls, to make people aware of inconsistencies or downright incorrect information that's perhaps online about you being liable to 6% Philippine estate tax on your worldwide assets, which is complete nonsense. It's not true, as I've already explained. Please comment in the comments section below. Until next time, enjoy.